Americans have gotten considerably poorer relative to the rest of the world over the last 6 months. The US dollar index has dropped by almost 11% in the first half of 2025, which marks the worst decline on the US dollar index since 1973. And the bad news is that things are about to get much worse. When the US dollar index weakens, it means that the dollar is losing value relative to other currencies around the world. This includes currencies like the euro, the Canadian dollar, the Swiss franc, Japanese yen, and the Swedish krona. Over the course of the last 15 years, Americans have gotten used to seeing their purchasing power rise relative to the rest of the world. Since 2011, the US dollar index has risen by 36%, which has represented a massive increase in the wealth of Americans relative to the rest of the world. For instance, the dollar has risen by 27% against the euro, by 80% against the Japanese yen, by 67% against the Australian dollar, and the list goes on. Americans have gotten unbelievably rich relative to the rest of the world as a result of this appreciation of the US dollar. But, for better or worse, the current administration is on a mission to reverse this trend. Dating back to his first term in 2017, Donald Trump has consistently criticized the overvalued dollar. He has blamed it for Americans' huge trade deficit and the massive job losses in the manufacturing sector. And he's not entirely wrong. A strong dollar does disincentivize foreigners to purchase American-made goods and services, which naturally widens the trade deficit and has contributed to the loss of jobs in the manufacturing sector and other industries. Donald Trump's goal is to reverse both of these trends by weakening the US dollar. And as we're going to see, he's probably going to get his way. Today we are in a situation where the US interest rate stands at around 4.5%. If you compare that to the interest rate of the European Central Bank, for instance, it currently stands at 2.15%. So that means the gap between the two is roughly 2.35%, which theoretically makes the dollar much more attractive to hold today. We can look at what the spread between the US and European interest rates looks like going back to 1999. And we can see that this spread between the US and European interest rates has been positive since 2015. In other words, the US dollar has consistently provided investors with a higher return than the euro over the last decade. This is very different from the 2000s, for example, where the spread often dipped below 0%, suggesting that the European interest rate was actually higher than the US one. This high spread that we have between US and European interest rates is exactly what Donald Trump is aiming to reverse. Trump has been putting tremendous pressure on the current Fed Chair Jerome Powell to lower interest rates, and it's safe to say that the next chairman of the Federal Reserve that will be appointed by Trump will almost certainly be biased towards lowering interest rates, and that is potentially setting up the US dollar for a massive decline. The US dollar is still at one of its strongest levels when looking at something called the real effective exchange rate. This is an index from the Bank of International Settlements that adjusts the exchange rate of the currency for inflation. Now, that might sound complicated, but the index is basically meant to tell us how overvalued or undervalued the US dollar is relative to other currencies. At the beginning of this year, the real effective exchange rate for the US dollar was 112, a level only seen in 1985 and 1970. We've had a little bit of a decline since then, but it remains very much at the top of its historical range, meaning that the US dollar is still overvalued according to this index. This leaves potentially plenty of room for the US dollar to decline from here. Just coming back to the historical averages of around 90 would mean an additional 15% decline from current levels. And as I'm going to show you, it could even be that we see this index dip all the way down into undervaluation. Before you rush to exit this video and go leveraged short on the US dollar, I want you to first watch a YouTube video that I linked down below that I put together to show you exactly how to take advantage of this kind of macro trade. And it generally shows you how to put yourself on a path to becoming an extremely profitable macro trader in 2025. I go through the big lessons that I learned the hard way throughout my career and the key factors that I've seen truly make traders successful in the market. I'm going to leave the video link in the description down below. I strongly recommend that you check it out before you start trading or investing for that that matter. So one of the things that could cause this kind of massive drop on the US dollar's valuation is none other than the government's spending. Donald Trump's One Big Beautiful Bill that has just passed certainly could act as one of the catalysts for this. Although he has made some cuts to government spending in certain areas like Medicaid and renewable energy, this has been more than offset by the tax cuts that he is implementing, which amount to a massive $4.5 trillion in deficit spending over the next 10 years. And we happen to think that this deficit spending is actually part of his plan to weaken the US dollar. When we look at the US government's budget deficit going back to the 1990s, we see there are three key periods where the government actually managed to briefly reduce its deficit. This was in the 1990s, in the early 2010s, and briefly in 2021. In all three of these instances where the government reduced its spending, the US dollar rose substantially. And this makes sense. As investors see that the government is getting its budget under control, it naturally brings confidence to the government's currency. Now look at what happens when the government is widening its deficit. Generally, it causes the US dollar to decline. And the Big Beautiful Bill is going to lead the deficit to widen, which will likely put downwards pressure on the US dollar. Now, it won't be a straight line down, but we do think that there's plenty of room for the US dollar to weaken over the course of Donald Trump's term. And this is something that we're actively betting on at bravosresearch.com. We think this is going to provide tailwinds to asset prices. US stocks and real estate could benefit, but the real opportunities of a weak dollar are in foreign stock markets that thrive when the US dollar is weakening, and assets like gold and Bitcoin that are inversely correlated to the US dollar. At Bravos Research, we are actively positioned for this shift. We've ramped up our exposure to Bitcoin and the mining stocks that we think can outperform the most, and we're actively looking for opportunities in foreign stock markets, particularly India and Argentina. Again, in the description down below, you'll find a YouTube video that I put together that shows you exactly how to take advantage of these kinds of opportunities in the market. This includes some of the biggest insights that I've learned the hard way throughout my career, so make sure you don't miss it. Thank you for watching.